Good morning. This is Kenya News Update today. In a landmark legislative move, the National Assembly has passed the National Infrastructure Fund Bill 2026, a piece of legislation that could fundamentally reshape Kenya's development trajectory. The bill, designated as National Assembly Bill No. 1 of 2026, was approved on Thursday, March 5th, after lawmakers adopted it during the third reading. It now awaits the assent of President William Ruto to become law. The core mandate of this bill is to fast-track the development of key national infrastructure projects and, crucially, to attract private and alternative financing to bridge Kenya's massive infrastructure funding gap. We are going to take a deep dive into what this bill entails, the political journey it has taken, the specific projects it targets, and the fierce debate surrounding its passage. We'll also examine the financial mechanics, the governance structure, and what this means for the average Kenyan. This is a 12-minute deep dive into one of the most significant economic bills of the year. Let's begin. First, let's understand the scale of the problem this bill aims to solve. Kenya's infrastructure deficit is a well-documented constraint on economic growth. The Kenya National Bureau of Statistics, in its 2025 economic survey, estimated that the country needs to invest approximately 4.5 trillion shillings over the next decade to meet its infrastructure needs in transport, energy, water, and digital connectivity. Currently, public funding through the Exchequer covers less than 40% of this requirement. Annual budget allocation for infrastructure in the 2025/2026 financial year stands at 650 billion shillings. This leaves a staggering annual shortfall of nearly 800 billion shillings. The National Infrastructure Fund, or NIF, is designed to be the vehicle that mobilizes that missing capital. It proposes to consolidate existing infrastructure-related funds and attract new investment through a structured, project finance approach. The bill was introduced by the Majority Leader, Kimani Ichung'wah, signaling its importance to the government's legislative agenda. Its passage, however, was not without controversy, which we will explore in detail. To understand the NIF's proposed structure, we need to look at its key pillars. The bill establishes a fund that will be managed by a board of trustees. This board will have 11 members, a chairperson appointed by the president, the principal secretary for the National Treasury, the principal secretary for infrastructure, the governor of the Central Bank of Kenya, and 7 other members drawn from the private sector, including experts in finance, engineering, and law. The fund's initial capitalization is proposed to come from 3 main sources. First, a one-off seed funding of 50 billion shillings from the National Treasury. Second, the consolidation of 5 existing ring-fenced infrastructure funds, whose combined assets are valued at approximately 120 billion shillings. These include the Road Maintenance Levy Fund, the Water Services Trust Fund, the Rural Electrification Program Fund, the Universal Service Fund for ICT, and the National Housing Development Fund. Third, annual appropriations from Parliament, projected to start at 100 billion shillings in the first year. The goal is to grow the fund's asset base to 1 trillion shillings within 5 years. This capital will then be leveraged to attract private co-investment. The bill proposes a matching model, where for every shilling the NIF invests in a project, it must attract at least 2 shillings from private investors, pension funds, or development finance institutions. This could theoretically unlock up to 3 trillion shillings in new infrastructure investment by 2031. Now, let's look at the specific project categories earmarked for NIF financing. The bill outlines 4 priority sectors. The first is transport and logistics, which is allocated 40% of the fund's investment capacity. Key projects here include the completion of the remaining 200 kilometers of the Nairobi-Mombasa Expressway, the development of the Kisumu Port and associated inland waterways, and the construction of the 150-kilometer Isiolo-Moyale Highway to bolster regional trade. The second sector is energy and renewable resources, allocated 30%. This focuses on accelerating geothermal development in the Menengai and Salali fields, expanding the national transmission grid to connect an additional 500,000 households, and building large-scale solar parks in Garissa and Kitui. The third sector is water security and sanitation, allocated 20%. Flagship projects include the Northern Water Collector Tunnel Phase 2, the Thwake Multi-Purpose Dam, and new sewerage systems for 15 rapidly growing secondary towns. The final 10% is allocated to digital infrastructure, specifically the last-mile rollout of the national fiber optic backbone and public Wi-Fi hotspots in all 47 county headquarters. Each project must pass a rigorous feasibility test and demonstrate a clear revenue model, either through user fees like tolls or through structured government payments. The political journey of this bill has been intense. It was first tabled in Parliament on January 15, 2026. It underwent the first reading on January 20th and was committed to the Departmental Committee on Finance and National Planning for scrutiny. The committee, chaired by Honorable Kuri Akimani, conducted public hearings over 3 weeks, receiving submissions from over 50 stakeholders including the Kenya Private Sector Alliance, the Institute of Engineers of Kenya, the Law Society of Kenya, and several civil society organizations. The committee's report, tabled on February 25th, contained several contentious amendments. One major point of debate was the governance structure. Critics, led by Minority Leader Apio Wandayi, argued that having the president appoint the chairperson and the Treasury wielding significant influence risked politicizing the fund. They proposed a more independent appointments panel. This amendment was defeated by a vote of 120 to 95. Another heated debate centered on transparency. The original bill required project contracts and financial reports to be submitted to Parliament annually. An amendment from the committee, which was adopted, now mandates quarterly disclosures and public posting of all major contracts on a dedicated portal. The third reading and final vote on March 5th saw the bill pass with 180 votes in favor, 72 against, and 8 abstentions. This clear majority underscores the government's strong parliamentary backing, but also highlights a significant opposition bloc with deep reservations. Let's now hear the perspectives that shaped this debate. Proponents of the bill argue it is an economic game changer. Majority Leader Kimani Ichung'wah, during the debate, stated, "This is not just another fund. This is Kenya's strategic answer to the infrastructure financing puzzle. We are moving from a model of scarcity to a model of abundance by tapping into the deep pools of private capital that are eager for bankable projects." He pointed to the success of the Nairobi Expressway, a public-private partnership, as a model the NIF would replicate nationwide. The Kenya Association of Manufacturers issued a statement welcoming the bill, estimating that improved logistics and energy reliability could reduce the cost of doing business by up to 15%. On the other side, critics raise alarms about debt and accountability. Economist Dr. David Ndea, in a televised interview, warned, "The NIF is a conduit for off-balance sheet borrowing. These projects will have sovereign guarantees. When the toll revenue doesn't materialize, as we've seen in some projects, the taxpayer will be on the hook. We are creating a massive contingent liability." Civil society groups, led by the International Budget Partnership Kenya, have criticized the oversight mechanisms as still too weak, arguing that the board's composition does not guarantee independence from executive influence. They also question the prioritization of large, flashy projects over basic maintenance of existing infrastructure. Financially, the model is complex. The NIF will operate as a revolving fund. Returns from successful projects, such as toll collections or energy sales, will flow back into the fund for reinvestment. The bill sets a target annual return of 8% on invested capital. To mitigate risk, it mandates that no single project can consume more than 15% of the fund's total assets at the time of investment. It also requires a minimum credit rating of A for any private financing partner. A key innovation is the creation of infrastructure bonds specifically tied to NIF projects. These bonds, to be issued on the Nairobi Securities Exchange, would allow retail investors to participate. The Treasury Cabinet Secretary, in a briefing, suggested the first bond issue could be for 75 billion shillings to fund the digital infrastructure component. However, financial analysts caution that the success hinges entirely on project selection and management. A failed mega project could cripple the entire fund's returns and its ability to raise future capital. The timeline for implementation is aggressive. If assented to by President Ruto in the coming weeks, the board is expected to be constituted by June 2026, with the first project approvals slated for the fourth quarter of this year. What does this mean for the average Kenyan? The government's promise is one of tangible, rapid improvement. In the transport sector, the goal is to reduce the travel time from Nairobi to Mombasa to under 4 hours, and from Nairobi to Kisumu to under 3 hours within 5 years. In energy, the target is to bring the cost of electricity for manufacturers down from the current average of 15 shillings per kilowatt hour to 10 shillings per kilowatt hour. For water, the aim is to increase the national coverage of piped potable water from 60% to 85% of the population. These are ambitious targets. The counter-narrative from skeptics is that these large projects often come with displacement, environmental concerns, and cost overruns that ultimately burden citizens. The construction of the standard gauge railway, often cited as a precedent for large-scale infrastructure, remains a subject of debate regarding its economic return versus its debt burden. The NIF's Community Engagement Clause, which requires public participation for projects affecting local communities, will be a critical test of its social license to operate. In conclusion, the National Infrastructure Fund Bill 2026 represents a bold and high-stakes policy shift. It is an attempt to break the cycle of underinvestment in infrastructure by creating a dedicated, semi-autonomous financing machine. Its passage reflects a political consensus on the need for accelerated development, but the details reveal deep fissures over how to achieve it responsibly. The coming months will be crucial. The appointment of the first board will signal the government's commitment to professionalism or patronage. The selection of the inaugural projects will show whether the fund will prioritize economic return or political expediency. And the ability to attract private capital at the envisioned scale will be the ultimate test of the model's viability. For Kenya, a country with immense potential but persistent infrastructure bottlenecks, the success or failure of the NIF could define its economic path for a generation. The bill is now on President William Ruto's desk. His assent is considered a formality, but the real work begins the moment he signs it into law. This is a story we will be following closely. For Kenya News Update Today, I'm your host. Thank you for watching. Subscribe to Kenya News Update Today.